Shashank Khade, Executive Vice President, Portfolio Management Services with Kotak Securities, joins us live. Shashank, morning. Thank you for joining us. Shashank, this week's price action and volume action for Indian markets has been rather disappointing. Despite a rate cut and the kind of global strength of late global equity markets have exhibited, Indian markets are now suddenly underperforming.
No, I think my sense is that, it's more to do with, the GAR issue and the way the FIs are, incrementally investing in India. If you ask me, rather than having a huge expectation on rate cuts going forward, it's better that, the market actually takes it slowly and steadily in its stride and, discounts it slowly. Because I think the key issue here is, while there was a huge positive surprise on the quantum of rate cut this time around, it was quite clear that the next rate cut could be far away. It could not be really, quickly in the next 2 to 3 months. I think that's something which possibly has led to the market, not really, really moving up substantially after the event, though the positive surprise element was around. And I think the market is going to be really waiting it out for, when can the next rate cut, actually happen. Because given the way the elevated crude prices are, the room to further, reduce rates is going to be far lesser for RBI. So I think it's going to be possibly a larger interval to really look at over which the rate cuts are going to happen. So it's going to be a gradual, sort of decline in rate cuts. They've also hinted that if inflation risk persists, there is also a possibility of a rate hike. So, so I think one has to really look at whether, the monsoons are normal, food inflation doesn't come back, whether the oil sustains here, or the delta between WTI and Brent actually shrinks, because that could be a good positive surprise. All these factors are going to be really important to really see how the rate cycle really moves on from here. On the Indian markets front, I think, it's more to do with the earnings season right now. We haven't really started off with right earnest. We also had an issue where, Infosys, one of the index heavyweights, did not really, outsmart the market or, surprise the market positively. In fact, it surprised negatively. So it's all about the earnings season right now. I think it's clearly, and of course, last couple of days has been, the risk on, risk off sort of change in Europe, thanks to what happened in Spain and the way Spain is shaping up. So I think we have less to do with the European markets and the US markets right now, and more to do with the earnings season, because this earnings season is going to really build the base for how you project FY13 and 14. So I think from that perspective, this earnings season is quite crucial, and we'll continue to move as per the earnings which we really get in this particular season right now.
So Shashank, in that light, how does one approach an HDFC Bank right now? It's always been a steady performer, and that has been the case for the past many quarters. Steady 30% growth performance, but the valuations are rich. So which one would you pick? Would it be growth or valuations? And, is it well placed for FY13 as well?
Yeah, so if you look at, the markets right now, the leadership within the market is changing. And you have a situation where, say, a Tata Motors, an ITC, HDFC Bank, they're actually making lifetime highs, while you also have a case of Reliance Industries, one of the index heavyweights, or Infosys for that matter, really limping right now. So you have this huge disconnect in terms of, how various large index heavyweights are really performing. So I think, if you look at the trend between, say, a Hindustan Lever, ITC, HDFC Bank, or a Tata Motors, clearly I think the market is saying that we will invest where we see visibility of earnings, where we are reasonably sure that the earnings growth will come over the next year to 2 years. And I think that's where money is really flowing in. And that's the reason why, even if these stocks are expensive, they actually are, getting into a more expensive sort of a territory. And people are not really, willing to really take risk on the other side. And hence there is a huge gap between, the steady performers and the cyclicals which people would tend to really buy when, the risk-taking abilities are much higher. So I think it's, the leadership is clearly changing in the markets. That one can really see as a trend.
Shashank, there is a divided, divided opinion on how investors should, play consumption as a story in India. Some believe the best way to invest in consumption is to buy banks, which is a proxy of consumption. Some believe it is time to buy autos because that also is a proxy, and some believe the best way to play consumption is to buy FMCG and consumer names.
My sense is, I think, consumption in the last 3 to 4 years, people have looked at various ways in which one can play them. So it started off with the FMCG stocks, the pure consumption related, stories to play the demographics and change in, demand patterns because of the way rural demand is coming back. So people actually played that to a large extent. Banks clearly was, case where people said that if you want to buy into a bank, you get both consumer, corporate and, infrastructure related upsides. So why not really look at them? So people actually tended to look at private sector banks, thanks to the high amount of retail lending. So I think, that sort of way in which people wanted to play banks is also by and large factored in. So if you ask me, banks clearly right now, the way they are, of course, these are great plays. These are leverage plays on consumption. But the issue here is on the asset quality front, especially a number of these PSU banks are facing headwinds from, the lending which they've done in 2009 onwards, be it infra or, various other sectors. So I think it's the asset quality which is really, keeping these stocks under wraps. And there's a disconnect if you look at between the way the PSU banks are trading at and the private sector banks. And clearly people are ready to give a premium for quality of earnings and, good asset quality, in these banks. So if one were to play the banks, clearly yes, of course, these are great plays to look at from the consumer side. However, the price to books don't give you large upsides or, from here on. So it's going to be a slow and steady process. The earnings have to really catch up. The price to book multiples have to go down as the earnings grow. And, maybe that's the time where one can really bet on banks. So banks are clearly going to be long-term bets. But right now, as we speak, in this earnings season, it's going to be stock taking on asset quality in a number of banks. And the same thing will possibly happen in the next couple of quarters as well. But I think this quarter will be quite important to see whether there are restructurings which are continuing and the extent of restructuring which various banks have gone through. It's going to be a case-to-case, sort of basis, not a sectoral sort of investing from here in even banks at that moment.
So long-term, if you're bullish on banks, what about medium-term? What about short-term? Pick a spot for us where you see a trade or some kind of a money-making opportunity.
No, I think in the banks, it has to be, as I said, in the next couple of, look at it in the next 4 to 5 quarters, as I see it, things can pan out. One is, of course, right now inflation risks are high. The rate cut has just happened. If you look at the rate cut, it is nothing but a lifeline given to, the industry, the corporates, the infrastructure companies, so that there is some alleviation in terms of interest rates. And of course, it will take time for the further rates to really, change. So it's going to be a slow and steady process. At the same time, the asset quality related issue will possibly mellow down with this particular rate cut to some extent. It may not aggravate as much as had the rate cut not happened. So to that extent, some of the banks could be well placed. My sense is that, if you look at the government, clearly government is giving more impetus on the infrastructure, sector, be it ECB access or for that matter, banks, ability to give more loans to infrastructure NBFCs. My sense is that, the companies like Power Finance Corporation or REC, which have really gone beaten down because of, the SEBs and the state of finances of SEBs, I think these are great places to look at because a lot has happened from, the point which we started discounting these poor health of, SEBs to now. And Power Finance Corporation, and again it's a play on valuations. So valuations have factored in most of the negatives in these sort of companies. So both these plays can be quite important to look at.
Shashank, whereas Infosys Technologies clearly has guided that they will grow at a run rate which will be lower than the industry average, but HCL Technologies seems to be singing a different song. In the near term, do you think it makes sense to sell Infosys and buy HCL Technologies?
No, I think it could just be the other way around because, while HCL Technologies has delivered good numbers and that's got factored into the price, you have a situation where Infosys has negatively surprised and, the stock has reacted based on that. So it could be a point where Infosys from here could be interesting to look at, while HCL Tech, one could possibly take profits. So it could be just the other way around. So I think it's sell on good news and, buy on bad news. That could be a trade which one could possibly look at in Infosys vis-a-vis HCL Tech. Having said that, I think the room for disappointment, or I think one needs to really wait for the entire earnings of four IT companies to really come out before really taking a call on the IT sector, because clearly BFSI as a sector is a sort of trouble spot right now for these IT companies. So maybe wait it out for TCS earnings and then take a call on which stock to really bet on.
Shashank, momentum has a new definition now. The new momentum stocks are Titan, TTK Prestige, Bata and VIP. So out of this new momentum list, which are the ones you like?
I think I would not really go by this momentum in these stocks. Be these stocks or the white goods stocks which are right now sort of trending up. Because my sense is that the consumption which has been assumed as linear in the last 3 years may not really be so. So be it a Titan or for that matter a TTK Prestige, you may not really see linearity in demand coming up in this financial year. So it's going to be really hard to bet on these companies given the fact that valuation comfort, the margin of safety in these stocks is clearly not as much, and there is going to be a good chance of a disappointment in the next couple of quarters given the fact that the expectations are running really high. So I would stay away from these stocks for sure.
Okay, Punjab National Bank has slashed deposit rates. Now these are not lending rates. Now if you're slashing deposit rates and lending rates both, this move will protect your NIMs. But at a time when liquidity is tight, if you slash deposit rates, obviously the incremental growth in deposits will not be all that strong. Shashank, is that a concern for large cap PSU banks? Now one side you've got Reserve Bank of India which has slashed rates, which means rates in the system automatically will move down. But if you look at the total, if you look at the banking system per se, liquidity is tight, and if they slash deposit rates, the NIMs will come under pressure.
No, I think the issue is, which bank has what level of CASA right now and can sustain, with decline in deposit rates. If you have a high level of CASA, you can still, sustain for, a medium term with slashing deposit rates. The issue here is that has the bank been able to incrementally get deposits, especially in term deposits, money, because clearly the banks are not getting as much as money in the deposits what they're seeking, unless they're really going to make it very attractive and raise the cost of funds substantially higher. So the question is, from bank to bank, what level of CASA are they sitting on, and what the strategy would be, in the near term? Is it to take money at the cost of higher cost of funds, or let go the opportunity of these term deposits at a higher cost? So I think it depends on the asset liability sort of gap, or how the liabilities are placed for various banks, and it's going to be case to case for various banks.